There are 10 banks that are risky, just like Silicon Valley Bank. A lot of folks want us to believe that what happened at Silicon Valley Bank is unlikely to happen at other banks. The reason for that is they're under the impression that nobody else has the similar kind of exposure that they do to startups or venture capital money freezing up. But the sad reality is there is a formula that we can use, and this is not a foolproof formula. It's not a guarantee that these banks are going to have trouble, but it is a formula that gives us an idea of how do other banks compare to the Silicon Valley Bank. And the way the formula works, and I'm going to very much simplify this because it's very, very complicated, is we're going to take something known as the AOCI. So let's draw, let's hold on a second. Let's go, where's my little pencil here? Get my pen, there we go. All right, we're gonna take the AOCI. This stands for Accumulated Other Comprehensive Income. Income. So if the income is negative, it's potentially a problem, right? We are going to take that number and we are going to divide it by the total capital, so the total sack of cash these companies have, minus that loss. And we're going to come up with a ratio. That's important. We want to know what that ratio is because whoever has the highest ratio would imply greater financial risk, right? So let me make this a little bit more clear because I understand when you see this formula, and at first it looks complicated, okay? So the way it works again is AOCI over total capital minus AOCI. So in other words, if my losses are $10 and I have $110 and my AOCI is 10, well then the ratio here is 10 over 100, 10%, right? Positive or negative doesn't really matter. In this case, we'll just call it negative because AOCI in this case is a loss, so it's negative. Okay, that is simple. I don't want you to get lost there at all. It's basically just a ratio. And the bottom line is, the bigger that number, the worse, okay? Very, very simple. Now, in English, what does this mean? What this means is, what kind of losses do we have? And when we take those losses, how does that compare to the cash bag left after we consider those losses? So in other words, once we realize those losses, how much money we got left, man? That's all I want to know. Losses divided by how much money left. And then the bigger the percentage of losses compared to how much money is left, the riskier, right? So bigger percentage, bad. That's simple. That's what we're trying to do. And so Bloomberg put together this phenomenal list of banks that have, they put together 10 banks. And in this list of 10 banks, they show us which banks are potentially, looking at the worst sort of ratios. And I'm going to show you exactly those. So these are the worst 10, according to Bloomberg. These are their numbers, not mine. So don't sue me, bro. The number 10th worst bank was Prosperity Bancshares out of Houston, Texas. They had a ratio of negative 0.1%. Actually seems pretty nominal. The bank has somewhere around $37 million in assets. Okay, well that's not that bad. So you kind of get the picture there. On one side, you're going to see, hey, how many assets do they have, right? In that case, it was like 37 million or whatever. And then how does it compare? How do their losses compare to that, right? That's all we're doing here. We're trying to make it very, very simple. Okay, now let's look at the next one. And keep in mind, we're going to find Silicon Valley Bank on this list. But what I want you to pay attention to is where on the list is Silicon Valley Bank and which bank is actually worse than Silicon Valley Bank. And I hate to say it, it's a pretty damn popular one. All right, ready for this? All right. Number 2, First Foundation, negative 1%. You can see that right here, negative 1%. First Republic Bank, negative 1.9%. That is a San Francisco bank in California. First Foundation was the Dallas, Texas branch. Now, I do have sort of a trick, by the way, and I don't know if this is like mean or evil, but if you're trying to get your money out of a bank, I think one of the best things you could do is if you go queue up at the bank is say you need to make a deposit. Maybe that's evil, but it's what I would be thinking about doing. It's like, hey, I need to make a deposit. And then like go deposit like $20 into one account and go withdraw a ton of money out of another account. See what I'm saying? I don't know. I think you might be able to skip the line a little bit. Next, New York Community Bank Corp, negative 6.6%. Assets, we're at 90 mil over here. What do we got over here? Dime Community sitting at 7.5%. What's the next one? Sandy Spring Bank Corp, 8.2%. Next one, Pacific Premier Bank Corp from Irvine, California, negative 8.7%. Customers Bank Corp, negative 10.4%. Silicon Valley Bank, negative 10.5%. See where it's sitting? Like, that's pretty close to some of these other ones. Again, doesn't necessarily mean the other ones are going to hit a bank run, right? But 10.5%. Okay, you ready for this? Next one. In a worse position than Silicon Valley Bank, Columbia Financial, 10.5% to the negative. And here it is. You ready? You ready for this? This is a good one. You ready for this one? Check out the programs on Building Your Wealth, link down below, and make sure to take advantage of the coupon code for the programs because we've got a St. Paddy's Day coupon code for everything from Zero to Millionaire, our most popular course, Zero to Millionaire bundled with Stocks and Psychology of Money, or the other programs. Oh, no, it's actually Ally Financial. Ally Financial sits at negative 24%. Ally, folks, Ally. Yikes. Like, everyone pitches Ally online. Ally, a Detroit, Michigan bank, shows an AOCI per Bloomberg, a 4.05 bill, total equity of 12.8, a total assets of 191.8. But you're sitting at this negative 24% ratio. The way they've calculated this at Bloomberg, I think that's crazy. So absolutely wild. But it's something to pay attention to. And I want to be clear, when I talked about total capital, talking about bank equity, that gets a little bit more complicated. We don't have to go into this. These numbers are straight from Bloomberg. I didn't make up these numbers. I didn't calculate the numbers. I just copied them over, okay? But I want to explain them. And this is not to say that definitely Ally is at greater risk than Silicon Valley Bank. It's to say that, wow, there is risk in the banking system. And that risk could be where you are. And so you want to be careful. There's a reason I keep saying on this channel, if you're at a smaller bank, get out. And I know people are hating on me, saying things like, oh my gosh, you're just creating FUD. But look, we've played this game many times before. I put my money where my mouth is. I took my money out of the small banks over a month ago. I had money and exposure to small banks over a month ago, before any of this disaster, because I'm like, rates are getting to the level where we could potentially start risking bank failures. I do not want to be a victim. So a month ago, I moved my money. Proof is in the pudding. And look, I know some people are like, oh, but that's the kind of fear that creates a bank run. I don't care. Like, ultimately, you have to do what's best for yourself. And that's protecting your own assets. It's not our problem if a bank fails. It's their problem. It's not your problem. It's like playing with your livelihood is not what you should do. Otherwise, you end up on the streets and bankrupt. So keep that in mind. These are 10 potential coming bank bailouts listed by Bloomberg or potentially other banks at risk. Just per this AOCI, the actual measure is AOCI divided by total equity capital minus AOCI. That's the fair value measure that they use. Remember, this does not mean these banks are going to have to be forced to liquidate. It just basically means they have a high level of paper losses. You can actually look up this money yourself at the Federal Financial Institution Examination Council National Information Center. Good Lord, that's a mouthful. Apparently, this evidence is taken from the Consolidated Financial Statements for Holding Companies Fiscal Year Y-9C filed with the Fed. Oh yeah, that's real easy to look up. But anyway, good luck.